Let's have a chat, shall we? Now, I don't know about you, but is there anything more sexy than talking about mortgage rates, basis points, and treasury yields? All right, well today I'm going to do my very best to break down some pretty complicated subject matter in a way that makes sense for you to understand why interest rates are currently so high, and more importantly, how mortgage rates are created. Okay, let's first start off dispelling some misinformation. Contrary to political beliefs, the president has very little to no influence over interest rates, basically none. In fact, presidents can be boosted or victimized by the direction the Federal Reserve takes. See, the job of the Federal Reserve is to not only regulate banks and other financial institutions, but maintain the stability of our financial system. Now, this includes systemic risks that may arise in financial markets. Now, currently, the head of the Fed is Jerome Powell. Now, the biggest misnomer is the fact that when you see the headlines about the Fed's raising interest rates, that this affects mortgage rates directly. Now, as you'll come to see shortly, while the Fed rate increases do affect mortgage rates, it's in a much more nuanced and indirect correlation. So what does it mean when the Feds raise interest rates, and why would they? Think about it this way. The more money you keep in your wallet, the more likely you are to spend that money. Now, if you give people lines of credit, most people are going to use those lines of credit.
Platinum belt with an unlimited line of credit.
Coming out of the pandemic, there were rational fears that the global economy would actually crash since so many people were out of work. As a result, the Feds started lowering interest rates, and our government essentially just went ahead and subsidized our economy with PPE loans and boosted unemployment, right? Now, as we know now, it turned into a completely perfect storm. Everyone felt rich, crypto became huge, and Wall Street took off. See, when the Feds raise or lower the rate, this is the rate that banks borrow money from. The lower the interest rate banks pay, the lower the interest rate they can charge customers. So this directly affects credit cards, car payments, and even adjustable rate mortgages. Simply put, this affects what's called consumer credit. Since America is basically a country reliant on consumer credit, the cheaper the interest rates are, the more buying power people have. Now, most Americans have an idea of what they want their car payment to be. Then you work the numbers backwards to see what amount they qualify for. So right now, the average new car payment is $777. At 7% interest over 6 years, that's about a $45,000 car. Now, if you drop that down to 1% interest, now that payment gets you a $55,000 car. So when rates are low, people and businesses spend more. The more people spend money, the more jobs are created, and eventually with such high demand for goods and services, prices start increasing. This is what we know as inflation. Well, over these past few years, we've seen everything blow up in price. While some inflation is healthy, the goal is to have between 2 to 4% annual inflation. Too much inflation starts to erode people's purchasing power as their income doesn't tend to keep up with the inflation. Which brings us to today. Now check out this chart of US inflation rates. As you can see, recently we've been completely out of control. Now, the only way the Fed can slow down inflation is to discourage people from purchasing so damn much. Since the Fed can't raise the prices of goods and services directly, they raise interest rates to make borrowing money more expensive. Now, the more expensive it is to borrow, the less people tend to purchase and consume products.
Hey, why don't you get a car? I can't afford it.
For middle-class people, their credit card bills just went through the roof. So, time to cut back on any needless spending if you're middle class in that category. Now, for wealthy people, the cost of their money just went up. So they tend to not borrow money to expand their businesses and things like that. Now, I've had clients personally these past few years with like $20+ million in the bank, but they still took out mortgages to purchase homes that they could easily pay cash for, multiple times over.
But that makes no sense.
Now, to the uneducated, this sounds absolutely silly. But if they can secure, say, a 3% mortgage for $5 million and their money manager is getting them a 10% return in the market, they're essentially making 7% just off their mortgage. And this is why the rich keep getting richer. So now that we understand the Fed's relationship to the economy, how on earth does this actually affect mortgage rates? Now, the answer here is both simple and complex. So let's start with the simple part. When the Feds raise interest rates, that affects all treasury bonds. Now, if you've ever heard of T-bills, these are basically bonds of government debt that people can invest in. These can be anywhere from 1 month to a year. Then you jump into treasury notes that can be anywhere from 1 year to 10 years. In short, you're basically investing in the US government. They're low interest investments, but with virtually no risk. Well, the 10-year Treasury note is the most widely tracked government debt instrument in finance. Now, when you consider the fact that mortgages are purchased and sold on Wall Street as securities, as an investor, I can purchase, say, government notes with absolutely no risk, or I can purchase mortgages, which, well, that didn't turn out too great in 2008, right?
Wow, that hurt.
So put simply, if I'm going to invest in mortgage-backed securities, I better be getting a much better rate than if I simply did nothing and purchased 10-year Treasury bonds with absolutely no risk. Now that you understand this relationship, check out this graph. Now, in red, you can see the 10-year Treasury note going back to 2000. Above in blue is the 30-year mortgage rate. You can see that the two lines literally mimic each other at almost an identical rate for like 20 plus years. The takeaway here is this. Historically, the 30-year mortgage rate tends to be 170 basis points above the 10-year Treasury note. In other words, 30-year mortgages tend to be 1.7% above the 10-year Treasury note. So when the Fed raises interest rates, that tends to raise the market yield on the 10-year Treasury note. When that happens, mortgage rates tend to be 1.7% above that amount. So if that's the rule, then why on earth are mortgage rates about 245 basis points higher instead of 170? So let's look at this graph. On the far right, you can see that the relationship today between the 10-year note and the 30-year mortgage. Now, I took that same delta, or the difference between the two, and slid them over to January of 2020, right before the pandemic, and March of 2021. Check out that massive difference. Once again, that's because right now, we're almost 2.5% above what was always about 1.7%. Which now adds the bigger question. Why the hell has this relationship become so dysfunctional? So now it's time to break down the complexity. Now, on top of the Fed trying to slow down inflation, we have three other factors that are contributing to this negative relationship: supply, risk, and what I'm going to call value. First, let's check out supply. Right now, the Fed has been literally selling off $95 billion worth of mortgages every month. This is twice as much as normal. So back to supply and demand. If you flood the market with supply, the value of that object becomes less valuable. As a result, many servicing companies are selling their servicing rights just to stay afloat. Servicing companies are the companies that you write your monthly mortgage payment to, and then they get paid to collect your mortgage payments and then return the money to the investor who actually owns your home. All right. Next, let's cover the risk portion. This is pretty simple. Now, I can either invest in US government and assume no risk, or I can invest in mortgage-backed securities with some risk. Well, over this past year, everyone has agreed that housing was in trouble. Now, how much trouble depends on who you ask. From an investor standpoint, if I'm going to potentially take on more risk than before, I want compensation for that risk. Basically, if people stop paying their mortgage like in 2008, I need to make sure that I'm charging a higher rate of interest to everyone to make up for those people that might stiff me down the line. That's pretty simple. All right, last but not least is the value portion. This is actually pretty cool. or at least as cool as talking finance gets you, right? See, banks and investors don't want you to pay off your debt. The longer you take to pay off debt, the more money investors make. We all know that the first 10 years are basically all interest paid up front when we're talking mortgages. So banks want you to hold that note for 7 to 10 years so they make more money. So think about it this way. Let's say I lend you $100 and I charge you $10 a week interest. Hell, I don't care if you ever pay me back the $100 because I'm making $10 a week. Now, in 10 weeks, I actually have all my money back and then some. So the longer you take to pay me back, the better it is for me. Well, right now banks are lending at 6 and 7% interest. These banks aren't stupid. They know that these rates are high, and they also know that rates will likely come back down at some point in the near future. So imagine I lent you that same $100. I verified your employment, I checked your credit, and I walked to the ATM to pull out $100 to give you. Now, I charge you $10 a week just to make this loan worth my time, right? But imagine you go home and tell your wife about the stupid loan you just took out. Now, she calls her friends and one of her friends agrees to pay off that $100 loan and only charge $5 a week. Well, damn, it wasn't even worth my walk to the ATM now. I went through all that just to make $10? Well, right now, banks know that borrowers are simply going to refinance these loans in the next couple of years as soon as rates come back down. As a result, lenders are charging even more than they should simply to cover the reality that they won't be making this interest for long enough to make it worth their while. So let's quickly wrap up what we learned here. The Fed raises and lowers interest rates to determine how fast or slow our economy is going to grow. The higher the rate, the more they pay investors for investing in the US government. But the higher those rates pay, mortgage investments have to keep up accordingly since they're riskier. With the Fed doubling the rate that they're selling mortgages, they're also flooding the market with all this supply. And with so much housing and economic uncertainty, mortgage buying has become a bit more risky than it was. Now, as a result, lenders are charging more for that inherent risk. And finally, now that rates are so high, investors are scared that they won't even be able to make these returns for too long. So they're charging more on top of their more. So as you can see, there's a lot more that goes into determining mortgage rates. Now, on the bright side, when the delta between the 10-year Treasury note and the 30-year mortgage exceeds that 1.7% or 170 basis points, you know that rates are inherently needing to come down to that level at some point. So at the time of this shooting, it's fair to say that at some point in the near future, rates have to come down 3/4 of a point just to maintain that normal relationship with bonds. So even if the Feds don't lower rates, at some point rates should come down almost a full percent just on their own. Well, that's it for this video, guys. I hope you enjoyed this breakdown. Please help me out by liking and subscribing to my channel. Till the next time, deuces.